Okay, let's dive right into this. Have you ever stared at those flashing green and red numbers on a stock ticker and thought, what is actually going on behind all this chaos? Welcome to This Explainer. Today, we're unpacking a massive, fundamental divide in the financial world. We're talking about the investor versus the speculator. We're going to step right inside the mind of a true investor to uncover what makes a company actually worth owning and how you can apply this kind of structured thinking to your own wealth-building journey.
To really wrap our heads around this, let's start with a scenario. Picture this. Two friends decide to invest exactly $10,000 each. They both step into the exact same stock market, right? But they choose entirely different companies to allocate their capital to. They lock in those choices and the clock starts ticking. Now fast forward exactly 5 years into the future.
We look at their accounts 5 years later and, well, we are forced to ask, what made the difference? Because one friend's portfolio has literally doubled in value while the other's has barely budged at all. And here's the thing, neither person worked harder than the other during those 5 years, neither of them personally built a company, and neither invented some groundbreaking new tech. So what was it? Blind luck? Was one friend just a financial genius? Or was it an understanding of a core principle that millions of people completely overlook every single day they interact with the market?
To figure out that overlooked secret, we really need to define what it is we're actually buying. When you buy a share, you aren't just buying a flickering ticker symbol on a screen. It's not a lottery ticket where you cross your fingers and hope for a random payout. You are taking an actual ownership stake in a real operating business. Think of a bustling neighborhood bakery. If you owned it, you wouldn't be obsessing over its minute-by-minute resale value, would you? Of course not. You'd be looking at its profit margins, customer loyalty, and maybe its expansion plans. Public markets are really just that bakery, just on a massive scale. So the key question shifts away from that frantic, hey, will the stock price blow up tomorrow, to a much more grounded, will this business create more value over many years?
And when a business does create that long-term value, it eventually rewards its owners in two primary ways: capital appreciation and dividends. But here is the catch. While a speculator gets incredibly impatient if a company doesn't pump its stock price immediately, an investor, a true investor, understands that great companies often take those profits and reinvest them right back into the engine to fund future dominance. Other companies might distribute a portion of their earnings as dividends while keeping the rest for growth. Honestly, these are the fundamental mechanics of how wealth is actually generated when a business thrives over time.
Let's put that into perspective. If a company expands its operations and creates products that people genuinely love, the market is eventually going to recognize that intrinsic value. Imagine you buy a share in a company when the overall market value is at $50. You hold on to it, and over the years, the company expands and its profit margins go up. If that valuation jumps from $50 to $90, that isn't magic. It's a direct reflection of real-world business success. That's capital appreciation right there in action, where you, the owner, directly benefit from the company's real-world growth.
But let's be real, getting from $50 to $90 is rarely a smooth, straight line. I absolutely love this quote from our source material for this explainer. The waves move constantly, yet the ocean itself remains. Imagine you're standing on a beach. You see waves crashing continuously, right? Some are tiny ripples, others are powerful, unpredictable surges. But the vast ocean beneath them, it's a constant presence. The stock market behaves in the exact same way. Prices bounce up and down every single day, acting like those surface waves. But the underlying reality of the market and the actual businesses operating within it, the ocean, well, that remains constant.
So, what's causing all these daily waves? Well, it's a relentless stream of new information. We're talking quarterly earnings reports, highly anticipated product launches, sudden shifts in interest rates, new economic data, unexpected tech breakthroughs, and massive global events. Actually, it's estimated that thousands of financial news articles are published every single day, constantly shifting people's expectations. And you know what happens when expectations change? Stock prices move. Sometimes wild optimism spreads like wildfire. Sometimes deep fear spreads just as fast. Understanding that all of this noise is entirely normal is the absolute first step to ignoring it.
Which brings us right to the core conflict of our explainer, the speculator versus the investor. Imagine two people stepping into that exact same volatile, wave-filled market. The speculator, they live in a state of constant reaction. They're glued to their phones, sweating over every micro fluctuation, buying because of FOMO, fear of missing out, and panic selling at the very first sign of a dip. In fact, research shows that a massive majority of pure day traders end up losing money over time simply because it is an incredibly stressful, chaotic way to operate. The investor, on the other hand, is totally grounded. They tune out those daily waves and evaluate the actual, fundamental health of the underlying business.
Instead of just reacting to the crowd, the true investor enthusiastically asks much deeper, structural questions. Things like, does this company solve a real problem? Does it actually generate consistent profits? Can it remain competitive against its rivals over the next 5, 10, or 20 years? Does its current market valuation even make sense? If you want to build long-term wealth, these are exactly the questions you need to be asking. Because remember, both the speculator and the investor are playing in the exact same market. But this fundamental mindset shift, moving from obsessively tracking price to actually evaluating business value, that makes all the difference in the world. To visualize the quiet power of time here, let's look at the story of two trees. Imagine planting two identical saplings. One tree represents the speculator's portfolio. It gets dug up every single week just to see if the roots have grown. The other tree represents the investor's portfolio. It's simply watered patiently and left alone to mature. Years later, the tree that was constantly disturbed has barely developed at all. But the tree that was given time, it provides abundant shade, fruit, and has incredibly deep, strong roots. Businesses are exactly the same. They desperately need time to innovate, to expand, and to grow those deep roots to create real, lasting value.
So even for seasoned participants, it really pays to audit your habits. Are you truly understanding the companies you allocate your hard-earned capital to? Are you managing risk thoughtfully? Are you thinking independently, or are you just blindly following the crowd? Remaining patient through all that inevitable market volatility is essential, as is continuing to learn. The market is not a casino, and it's certainly not a magical money printing machine. It's a transfer of business ownership. Mastering these core disciplines matters so much more than trying to chase the latest trending headline.
As we begin to wrap up this explainer, we have to look past those red and green pixels on our screens. Ultimately, the stock market is a reflection of people. It's not just abstract data flowing through some random server. Behind every single price and every single trade is human ambition. We're talking about entrepreneurs dedicating their lives to building companies, employees creating innovative products, everyday customers making choices with their wallets, and investors who actually believe in those bold ideas. Every single share tells the story of a business, and every price reflects millions of human decisions.
Which brings us to our final and perhaps most provocative question for you to take away today. When you approach wealth building, are you desperately trying to predict the future, or are you preparing thoughtfully for it? Because honestly, successful investing isn't about perfectly predicting every single market move or timing every little wave. It's about making thoughtful, informed decisions under uncertainty and remaining disciplined over a really long period of time. Adopt the mind of an investor, focus on the underlying business, and let patience do the heavy lifting. Thank you so much for joining me, and I hope you're leaving with a powerful new perspective on how to build lasting wealth.